There are 4 factors that you want to pay attention to. This is what the Federal Reserve Bank is looking at, so this is what you want to be paying attention to as well. It is the CPI, the PPI, the PCE, and the UE. Now, I know this is going to look very intimidating at first glance, but I'm going to break it all down for you, and I'm going to make sure it's very easy to understand. The CPI is the general inflation number, where every month you hear about what inflation is. This is that big number that everybody says that we are hitting 4-decade high inflation at near 9% inflation. That's what the CPI is, the general inflation number. PPI is the inflation number that businesses feel. So CPI is the inflation number that consumers feel when you go to the grocery store, when you have to pay for your gas, when you have to pay higher rent costs. That's the inflation that regular people feel. PPI is the inflation that business owners feel, because now when you have to go and produce a product, well, your raw materials are also going up because of inflation. So this is the inflation number that businesses are feeling. PCE is the core inflation number. That's what the Federal Reserve Bank likes to call it, where they take the CPI number and they strip out the volatile numbers. They take out energy costs, they take out food costs because nobody has to worry about these high expenses. But what the Fed says is that energy and food are very volatile, and so they don't give a good indicator as to what real inflation is. So this is one of the Federal Reserve Bank's favorite indicators to inflation. And then you have the unemployment numbers. UE. This gives you a gauge as to the strength of the economy, because these 3 numbers will tell you how bad inflation really is. And to fight inflation, well, you have to raise interest rates. And so these 3 numbers will give the Fed a gauge on how aggressively they need to raise interest rates, but the UE number, the unemployment number, gives the Fed a gauge into the strength of the economy. Because if the economy is strong, meaning unemployment is low, then they will be more likely to raise interest rates. However, if we see unemployment start to go up, meaning that now the economy is starting to slow, well, then the Fed is going to be less likely to continue raising interest rates, because now they might get worried about this and the economy. Right now, at the time of me recording this video, CPI is at the highest levels since the early 1980s. I think it's the highest level since 1980, where we're just under 9% CPI. So we have some of the highest inflation numbers that we've seen in decades at this top level CPI. But then PPI, which is the producer inflation, the inflation that business owners feel, is even higher than CPI. The producer inflation is above 10%. So what that means is you have these big industries, these big corporations that are paying more than 10% for their raw materials, and they're selling the products at about 9% higher. So producers are actually seeing shrinking profits because inflation is hurting the business owners more than it's hurting the consumers. I know there's a lot of confusing rhetoric going on around there, because people are saying, oh, it's greedy corporations that are causing the inflation. However, those greedy corporations are actually being hurt by inflation more than people. So that's one thing that you want to be aware of, where there is some misinformation being put out there, because if you just look at the numbers, this is worse than this. Then you have the core inflation numbers, the PCE numbers. Well, these PCE numbers that came out on June 30th, which was the latest numbers, were very high, some of the highest numbers that we've seen, but they were slightly lower than what the Federal Reserve Bank expected, which I guess is good news. However, the thing that you want to kind of caveat that with is it takes out things like gas and energy and food. And these are things that people have to pay for. Like, just because the Federal Reserve Bank doesn't look at these numbers doesn't mean that people don't have to pay the price for higher food costs. They don't have to pay the price for higher gas costs. However, even when you take away these volatile numbers, PCE is still hovering near the highest values that we have seen in decades. So we have extremely high PCE. So when you factor all these things together, what this tells us is we have a long and painful inflation fight ahead. So the Fed needs to do more things to fight inflation. But then if you look at the other side, now the economic side, which is the unemployment, unemployment today is extremely low. We are hovering at some of the lowest unemployment numbers ever. So why are people worried about an economic slowdown if unemployment is doing great because people all have jobs. It's because jobs are a lagging indicator. Just because a company starts to get worried about a recession doesn't mean they're going to start laying people off. A company starts laying people off, they start cutting their costs once the pain actually happens, and then they start to persist, and then the company is forced to do layoffs. So this is where you have to pay attention, not just to where jobs are today, but to where the unemployment numbers are going. Now, an easy way for you to stay up to date on all this type of information of what's going on is just to subscribe to Market Briefs. It is a free financial newsletter that I created where my team breaks down what's happening in the inflation markets, the economic markets, the stock market, the real estate market, and the crypto market into a free, fun to read, witty, and entertaining newsletter. You can read it in less than 5 minutes every single morning. So if you want to join Market Briefs and stay up to date on what's happening, I promise you, you are going to love and look forward to reading this email every morning. I'll put the link to how you can join Market Briefs down in the description below. Our economy is fueled by spending. The more money that you spend, the more money that somebody else makes. And so businesses need people to spend money in order for them to make profits, for them to invest in more growth, in order for them to hire more employees, and in order for them to keep their employees. And what's been happening now is over the last year or so, people had built up a large savings cushion. And because of everything that happened with the pandemic, people had extra cash. So the savings cushion helped the economy continue to grow even when people were facing this super high inflation. Because now when you face all this super high inflation, you can't spend as much money as you would have, or you can't spend money on other things that you would have, because now more of your money is going to buy you groceries and your gas and pay for your rent and your basic necessities, which means you have less cash to go out and buy other things. So while you might be spending more money, you're getting less stuff, just because more of your money has to go to buy your basic life necessities, and you have less cash to go out and travel. You have less cash to go out and buy nice things at the mall. You have less cash to go out and buy the fun stuff, because more of your money is being used to buy the necessary stuff just for you to survive. However, people have still been able to spend because they had this built up savings cushion from the pandemic, and because so many people paid down their debts from the pandemic. And so people not only were able to spend their savings cushion, but then people were able to build up their credit card debts again, which is not good news. However, this is one of the reasons why we saw the biggest boom in credit card debt ever just recently, because now people had no other option. They had to spend more money in order to keep maintaining the lifestyle, but inflation has not slowed down. And so now what we're seeing happen is spending is actually slowing down, meaning people are running out of their savings cushion, they're running out of this debt that they could have spent, and now they're having to cut back on their spending, and this is what's starting to slow down the economy in front of us right now. We're starting to see this take place in some sectors, like the tech sector, where layoffs are already starting to begin. However, as the Federal Reserve Bank continues to raise interest rates, you can expect that it's going to continue to slow down spending, and this will continue to raise unemployment, because companies will have to downsize as a way to reduce their costs in a time where interest rates are rising. This is why so many people are predicting that unemployment rates will continue to go up over the next number of years. And even the Federal Reserve Bank has come out and said that they expect unemployment rate to rise for the next number of years because of the interest rate hikes to fight inflation. This is where it goes back to the first question that I asked you in this video. What's going to break first? Is it going to be inflation, or is it going to be the markets? Because if the Fed now continues raising interest rates, that is going to hurt this, and that is going to hurt the markets. But if inflation does not come down and they're still raising interest rates, you can bet that that's going to hurt the economy. You can bet that that's going to hurt asset prices, from stocks to crypto to real estate. And that will continue to happen as long as the Fed continues to fight this. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide that goes over what passive income is, how to start generating passive income, and different passive income strategies. These are things that you can start doing even if you don't have a lot of money. So if you want to read this free guide on how to start generating passive income for free, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.